What if I told you that most of your trading wins weren't due to skill, but randomness? That uncomfortable truth lies at the heart of fooled by randomness. And unless you confront it, you'll stay stuck in a false confidence loop that ends in ruin. You see, your brain is hardwired to look for cause and effect. You make a good trade, you think, I'm improving. A series of green days, and you say, I'm consistent. But what if all of that was just a favorable streak in a probabilistic game? Nassim Taleb opens with a punch. Most market participants can't distinguish between random success and genuine skill. And that's lethal in trading. The markets reward randomness all the time. You win not because you were right, but because you weren't wrong yet. A trade moved in your favor, but you were exposed to hidden risk the whole time. And you called it insight. Taleb compares this to Russian roulette. If someone plays once and survives, do you praise their brilliance, or do you call out their recklessness? You've likely done this in your trading, held through drawdown, saw it recover, and called yourself disciplined. No, you got lucky. This illusion of control is seductive. It makes you feel smart, strategic, even destined for success. But randomness doesn't care about your story. Taleb warns of lucky fools, those who attribute their random wins to talent. They rise fast, gain followers, manage capital, then implode spectacularly. Sound familiar? Think about trading Twitter or the Discord rooms you've lurked in. The loudest voices often have the shortest time horizons. One hot streak and they start selling courses, but they're drawing conclusions from too little data. Taleb drills this in. A series of positive outcomes doesn't confirm skill. It could just be variance. And the more complex the environment, like markets, the more randomness dominates. Compare this with what Markdouglas wrote in Trading in the Zone. Anything can happen. You don't need to know what's going to happen next to make money. Taleb's work is the mathematical foundation for that truth. Your job is to execute a process that has positive expectancy, not to predict what happens next. Every time you confuse a random win with being right, you chip away at your edge. Now look at your journal. Be honest. Are you analyzing outcomes or decisions? Are you measuring skill or celebrating results? Taleb would tell you, stop judging trades by profit and loss. Judge them by whether the logic was sound, the risk managed, the exposure understood. Because in a world driven by randomness, only your process can anchor you. There's a line that hits hard. It is more random than you think. And the markets are more deceptive than they appear. That's a warning. When you start to believe your recent wins mean you've mastered the game, you're already setting yourself up for a massive blindside. So how do you internalize this? Start by assuming you're not as good as your P&L says. Focus on downside. Study the risks you didn't get punished for. Ask yourself, what would have happened if that news dropped 5 minutes earlier? This mindset won't feel good. It strips away ego, but it's your best defense. Also, detach from the outcome obsession. Just like Jared Tendler emphasizes in The Mental Game of Trading, your emotional tilt often comes from thinking you deserve the win. That's just another form of being fooled by randomness. Nobody deserves anything in this game. You earn survival by staying humble and keeping your edge intact, especially when it's working. Action step? Go back to your last 5 green trades. For each, write out what could have gone wrong. Then write, did this trade work because of my edge or despite my risk? If you can't answer honestly, you're gambling. And gamblers always lose to the house, eventually. You're not here to be lucky. You're here to become aware. Because the trader who sees randomness clearly survives. You celebrate the winners. You read their books, watch their interviews, follow their trades. But have you ever asked, where are the losers? Where are the traders who blew up, who vanished quietly, who did everything the same, except they didn't get lucky? That's the poison of survivorship bias, and Taleb makes it clear. If you ignore the silent failures, you're not learning. You're hallucinating. Survivorship bias is the filter that blinds you to reality. You only see the ones who made it. The hedge funds that survived 10 years, not the 100 that didn't. The trader who compounded 1 million, not the 10,000 who wiped before day 90. And you tell yourself, if he did it, so can I. But what if their success was just noise? Taleb paints the image vividly. Picture 10,000 traders flipping coins. By sheer probability, some will win 10 times in a row. Will you call that talent? Of course not. But replace coins with trades. Put those winners on CNBC, give them a best-selling book deal, and suddenly you start listening to them like sages. This is why blindly modeling successful traders is dangerous. You're modeling the surface, not the unseen variables. You mimic what they show, not what they hid. Taleb says, we see the winners and think their strategies work without realizing that the losers use the same strategies. In trading, that's deadly. It's why you might follow someone with a massive return curve without asking how many others tried the same style and didn't survive. The strategy might have worked this time. That doesn't make it repeatable. It doesn't make it robust. And worse, it doesn't make it safe. Let's bring in a contrast. In One Good Trade, Mike Bellafiore emphasizes process over outcome. His firm, SMB Capital, doesn't glorify lucky runs. They study risk management, consistency, and how traders handle drawdowns. Bellafiore sees the danger of survivorship bias. If you praise only the P&L, you create a culture of false confidence. The result? Blow-ups. Blow-ups. Taleb agrees. When you ignore the invisible graveyard, you worship a lie. Ask yourself this. How many of your trading heroes are only visible because of luck? How many influencers on YouTube or X are riding short-term volatility, confusing hot streaks with mastery? Taleb says, always ask, what's the denominator? For every one you see succeed, how many did you not see fail? That ratio is the truth. And don't think you're immune. You've likely done it yourself, ignored your own near misses, celebrated gains that weren't based on discipline. You might have said, I've finally figured it out. But were you filtering your own past, highlighting your wins, and forgetting your close calls? That's internal survivorship bias. Worse still, survivorship bias makes you overestimate your chances. You underestimate risk. You trade bigger because you think you've outgrown randomness. But in truth, you're still rolling dice. You've just stopped seeing the table. Here's a haunting quote from Taleb. The cemetery of failed traders is silent. That silence is what you must listen for. Every time you study a strategy, ask, what's the survivorship filter here? Who didn't make it? Why? Could I be next? Practical step, reverse engineer failure. Find blown accounts, read postmortems, study what not to do. Seek out traders who lost and got honest. You'll learn more from them than from the polished success stories. And in the words of Douglas, you must learn to accept risk without denial. Survivorship bias is denial. Your job isn't to imitate the visible few. It's to design a system that keeps you from becoming one of the invisible many. Don't chase the outliers. Study the graveyard. That's where wisdom lives. Because when you ignore the silent failures, you set yourself up to become one. Have you ever broken your trading plan because of a red candle that felt different? That's not intuition. It's narrative fallacy at work. Your brain doesn't just seek meaning, it manufactures it. And when randomness hits, it rushes to build a story to explain what just happened, a story to soothe uncertainty. But in trading, those stories become traps. Taleb introduces the narrative fallacy to explain this deeply human flaw, our tendency to connect dots that aren't connected, to link events in neat cause-effect sequences when randomness was the real driver. And the problem? These narratives feel true. Worse, they feel necessary. Because the truth that things happen without reason is psychologically unbearable. You've lived this. A stock dumps on no news. You can't just accept that it's noise. So you say, probably early selling from institutions, or maybe someone knows something. That's a narrative, a fabricated explanation to give you control in an uncontrollable moment. The media does it constantly. Stocks rise on optimism. Market falls on Fed fears. As if the same news doesn't trigger opposite moves the next day. But you absorb these stories, and worse, you internalize them. You make trades based on them. Taleb warns, the more random something is, the less it makes sense. Yet the more we try to explain it. That tendency is a psychological weakness you must fight. In trading, narrative fallacies infect your strategy. You look back at a chart and say, see, the double top was obvious. Or, I knew the breakout would fail after that doji. No, you didn't. You retrofitted a story to a random sequence of events. That's dangerous, because if you believe in that story, you'll try to repeat it. But markets don't owe you coherence. Here's how it shows up. You link a setup to a win and build a rule. You assume the outcome validates the narrative. Breakouts during lunch are fakeouts. Maybe. But maybe it was just randomness this time. You take one data point, attach a story, and call it a system. That's not trading. That's storytelling. Compare this to Jared Tendler's concept of emotional reasoning. You feel certainty, so you act as if the story is true. But emotions are poor evidence. Taleb and Tendler both urge you to break that link, to make decisions based on probability, not post hoc explanations. Let's go deeper. The danger isn't just believing false stories, it's building your identity on them. You start thinking, I'm good at reading price action. But are you? Or are you just crafting stories around past wins? Taleb calls this the narrative that makes you feel smart. But intelligence isn't what keeps you in the game. Risk management is. Ask yourself this: how many of your trading rules are built from actual data versus personal myth? Go through your journal, highlight every belief you have, then test it. Taleb's message is clear. A belief must survive contact with randomness to be useful. If it hasn't been stress tested, it's not a strategy. It's a superstition. Let's contrast this with Bellafiore again. At SMB Capital, traders are drilled in data, not stories. They learn to ask, what really happened in this setup? What's the sample size? Where's the edge? They kill narratives with numbers. You need to do the same. Here's a brutal truth. Stories feel better than uncertainty. But in trading, certainty is a lie. That red candle, it means nothing until it means everything. And by the time you figure out which, it's too late. You can't afford to wait for meaning. You must act based on structure, not narrative. Practical step: strip the story from your charts. Look at 100 trades, blind to context, and ask, did this setup work because of structure or because I told myself a story? Build filters that don't rely on explanations. Learn to say, I don't know why this happened, but I'll follow my rules anyway. That's real discipline. Because in a world ruled by randomness, the trader who clings to stories ends up trading fiction. You obsess over what happened. You replay trades. You analyze news. You review your chart from every angle. But do you ever ask, what could have happened instead? Because that's where real risk hides, in the events that didn't happen, the losses you narrowly avoided, the bullets you didn't know whizzed by. Welcome to Taleb's concept of alternative histories, a mindset that will shake your false sense of safety. You see, your brain remembers outcomes. You remember that the trade worked, that price hit your target, that news broke after you closed the position. But Taleb warns, outcomes blind you to reality. The fact that something didn't happen doesn't mean it wasn't close. And that gap between what did happen and what could have is where traders get destroyed. Imagine you went long before earnings. The stock jumped. You think, great call. But what if the company barely beat guidance? What if the price was one downgrade away from dumping? What if that big buyer pulled out at the last second? You don't see these non-events, so you assume your process is solid. But Taleb would shout, you're judging yourself by the path that unfolded, not the full spectrum of paths that could have. This is critical. Markets are probabilistic, not deterministic. Every trade has a distribution of outcomes, but you remember only the one that occurred. And over time, this warps your memory, your risk tolerance, your strategy. You start thinking you're safe because nothing bad happened. That's a fatal illusion. Taleb gives a chilling example. A trader who made millions betting on low volatility until 9/11 wiped him out. The trade worked for years. Then one event, one outlier, exposed how fragile the strategy was. Why? Because he judged his edge by what did happen, not what could have. You've probably done this. Held too long, ignored macro, and got away with it. But every time you survive randomness, you get more exposed to it. Alternative histories force you to ask, if I ran this trade 100 times, how many versions end in disaster? That's humility. That's realism. That's how pros think. Douglas hinted at this in Trading in the Zone. Thinking in probabilities means accepting that anything can happen, even if it usually doesn't. Taleb builds on this. He teaches you to see the silent graves of the paths not taken. So how do you apply this practically? First, trade reviews must include counterfactuals. Don't just write, it hit target. Write, if it reversed at midpoint, what would I have done? Map the unseen branches. Build mental simulations. Assume each win could have been a loss with just one variable flipped. Second, stop celebrating close calls. If your stop missed by 2 ticks and reversed, don't cheer. Ask why you were that close in the first place. Taleb says, the absence of a disaster doesn't mean you were safe. It means you got lucky. Those near misses are warnings, not validations. Third, rethink what you call a good trade. A good trade is not one that worked. It's one where the risk was known, the plan followed, the alternative scenarios modeled. Taleb urges you to think like an options trader, price in the tail risks. Don't just look at what's probable, account for what's possible. That's how you survive, and don't fall for hindsight bias. After the move, everything looks obvious, but it wasn't. The only way to fight this is by documenting your process before the outcome. Tendler calls this disentangling performance from emotion. Taleb calls it living in the counterfactual. Either way, it's how you stop lying to yourself. Start asking, what could I have missed? What didn't happen that I was exposed to? Would this trade still be good if the news had hit 15 minutes earlier? These questions don't feel good, but they keep you alive. Because when you train yourself to think in alternative histories, you stop measuring success by lucky paths and start preparing for the next random detour. In the end, your survival won't depend on what happened. It will depend on whether you respected what could have. You think you're smarter than the market. That this time, your red is different, that your experience gives you an edge others don't have. But what if I told you that confidence, your so-called conviction, is the very thing setting you up to fail? Taleb is brutal about this. Your ego is not just a vulnerability, it's your enemy, especially in trading, where randomness punishes pride without warning. In Fooled by Randomness, Taleb dismantles the myth of the heroic trader, the genius who beats the market, outsmarts the crowd, sees patterns others miss. He calls this figure what it is, a fiction. Because in markets driven by noise, the more convinced you are of your own brilliance, the less adaptive you become. And when the regime shifts, you're the last to know and the first to blow up. Let's get real. You've had moments when a trade goes against you and you double down, not because it made sense, but because you couldn't bear to be wrong. That's ego. You hold longer than your plan, widen your stop, reject the signal. Not because the setup changed, but because you couldn't take the psychological hit. And Taleb would say, that's not strategy. That's self-sabotage. The ego tells you that past wins mean future accuracy, that your insight is sharper than others, that you've paid your dues. But randomness doesn't care about your resume. Taleb points to countless successful names, traders who mistake a hot streak for a breakthrough. They become blind to risk, addicted to being right. And then randomness reminds them, violently, how fragile their edge really was. Douglas, too, warned you, the need to be right is rooted in fear. That fear, Taleb explains, gets camouflaged as overconfidence. You're not just betting on setups, you're betting on yourself being special. That's ego. That's dangerous. And don't think ego only shows up in grand gestures. It whispers during your wins. It nods approvingly when you ignore risk and still come out ahead. It says, you saw this coming. Taleb calls this retrospective arrogance. You interpret every correct call as evidence of brilliance and every miss as a fluke. Over time, this filters your learning. You stop adjusting. You start defending. Here's how it sneaks into your process. You stop journaling because you know your system. You skip reviews because you can feel the flow. You tell yourself the rules are for others, not for someone at your level. Ego blinds you to process, and when randomness strikes, you're unprepared. Compare that to professional firms like SMB. Bellafiore preaches humility. Their traders are taught to question their edge daily. The best ones journal religiously after both wins and losses. Why? Because they understand the thin line between confidence and delusion. Taleb would call this the skeptical ego. Confidence rooted in doubt, not arrogance. One of the most devastating quotes from the book: mediocrities tend to believe their luck is skill, while skilled operators attribute their results to randomness. Sit with that. The better you become, the more you should question your success. That's the paradox. If you're certain of your edge and never wrong, you're likely fooling yourself. So how do you dismantle the ego in trading? Start by adopting a mindset of provisional belief. This setup may have edge, but I will act only within parameters. Say it out loud. Document it. Make it mechanical. Second, ritualize humility. Write a short loss review after every green trade. What could have gone wrong? What part of this was luck? Taleb would smile at that. It means you're respecting randomness. Finally, detach your identity from your trades. You're not a good trader because of a green week. You're a good trader because you followed your system in the face of randomness. That's it. No glory, no genius, just discipline. Because in this game, the market doesn't punish weakness. It punishes overconfidence masked as strength. You're not here to be right. You're here to survive. You check the chart. Again, then your phone. You flip to your newsfeed, hoping for a reason, a story, something to justify what the market just did. A two-tick reversal suddenly feels personal. You think, maybe I should cut early. Or worse, maybe I should size up. That's not strategy. That's emotional addiction to noise, and it's killing your trading mind. Taleb exposes a powerful trap. The more frequently you look at market outcomes, the more randomness dominates your perception. And the shorter the time frame, the more emotional volatility overtakes rational decision-making. Sound familiar? Because this is where most traders live, on the edge of impulse, overstimulated by ticks that don't matter. He breaks it down with a brutal analogy. If you monitor a portfolio every second, you'll perceive more losses than wins, even in a statistically profitable strategy. Why? Because noise swamps the signal. Random downticks feel like failure. Random upticks feel like redemption. And that constant loop hijacks your emotions, distorts your judgment, and makes you trade the noise instead of your edge. You've felt it. You see a candle turn red and your stomach drops. You see it wick and suddenly you're euphoric. These micro-emotions are responses to non-events. They're false feedback. But if you act on them, if you start adjusting mid-trade, you're no longer following a system. You're just reacting. And Taleb's warning is clear. Emotional traders don't just lose, they self-destruct. Jared Tendler called this short-term tilt, the spiral triggered when emotion hijacks execution. Taleb shows you the cause, overexposure to randomness. You're watching too closely. You're seeing what you're not supposed to see. Imagine flipping a fair coin. Check it every hour and it'll look balanced. Check it every second and you'll swear it's rigged. The solution? Zoom out, literally and mentally. Taleb explains that the less frequently you look, the more clearly you see real trends. This isn't just theory, it's actionable. If you're a swing trader staring at a 1-minute chart, you're poisoning your strategy. If you're intraday but recalculating risk every candle, you're creating false signals. Noise isn't just useless, it's dangerous. Let's go deeper. Why do you obsess over every tick? Because you crave control. Every new bar feels like a chance to regain certainty. But Taleb makes it clear, this is illusion. You're chasing clarity in a cloud of randomness. You're confusing activity with productivity. And in trading, that confusion drains your capital and your psyche. There's a moment in the book where he talks about dentists earning more than traders because they operate in a world of clear cause and effect. Traders, meanwhile, live in chaos, but pretend it's deterministic. That's delusion. Your job is to operate in chaos without letting chaos control your process. So what do? First, restrict data input. Decide what timeframes and news matter to your system, and cut everything else. Turn off notifications. Stop reading breaking news unless it's part of your edge. Taleb would say, less noise, more process. Second, implement data fasting. Check results at set intervals, once an hour, once a day, whatever fits your system. The key is to reduce exposure to random feedback. Because the more you react to noise, the more your system mutates and eventually breaks. Third, redefine what feedback means. A win doesn't mean your edge worked. A loss doesn't mean it failed. The only useful feedback is whether you followed your process. That's the only input you should allow to shape your strategy. Bellafiore calls this the performance loop. You trade, you debrief, you adjust. But it must be structured, not emotional. If you're adjusting mid-trade, mid-bar, mid-thought, you're chasing ghosts. Taleb's philosophy reinforces the brutal truth. Randomness doesn't owe you clarity. Your discipline has to exist in spite of noise, not because the noise justifies it. And that's the shift. That's the mindset. You stop reacting, you start executing. So here's the practical test. Can you let a trade run without checking every candle? Can you trust your plan without watching it breathe? Can you detach from the chaos long enough to see the bigger truth? Because when you learn to ignore the noise, you start hearing your edge. You want consistent gains, so you design a system that grabs small wins, a few ticks here, a scalp there, Maybe you're shorting low-volume pops or hitting high-probability mean reversions. But deep down, you know the truth. All it takes is one black swan event, one unexpected reversal, and everything you've built can be wiped out in a day. That's the asymmetric risk Taleb screams about, and it's the risk most traders pretend doesn't exist. He introduces a terrifyingly real concept. Blow-ups are not accidents. They're inevitable outcomes of strategies that ignore rare events. You chase 95% win rates, you feel invincible, and you start trading size. But your edge is a mirage if it depends on the absence of extreme events. And when the outlier finally arrives, because it will, you're not just wrong, you're gone. Taleb uses the turkey analogy. The turkey thinks life is good every day it gets fed. Its confidence grows with each meal. But on day 100, Thanksgiving, it gets slaughtered. Everything looked fine until it wasn't. You, the trader, are the turkey if your system thrives in calm but collapses under chaos. That's the hidden asymmetry. It's not just about losing trades, it's about how you lose. A consistent $100 gain means nothing if one bad day takes $10,000. And yet you justify it. This setup always works. Or it's never done that before. Taleb would snap, just because something hasn't happened doesn't mean it can't. You see it in traders who short parabolics without hard stops, or swing traders who hold through earnings. The gains are real, but so is the risk of annihilation. That's negative asymmetry, small, frequent wins with massive, infrequent losses. Taleb's entire book is a warning against this structure. Contrast this with professional risk managers. They look not at average returns, but extreme losses. They ask, what's the worst-case scenario, and can I survive it? Bellafiore teaches his traders to prepare for event risk. They cut risk exposure before macro catalysts. They don't hope volatility stays muted. They hedge. They prepare. And when the black swan hits, they're still in the game. Because here's the truth. The game isn't about making money. It's about not blowing up. Taleb calls it avoiding ruin. You don't need to be perfect. You need to stay solvent. Only then can your edge play out. Let's talk probabilities. Most traders focus on high probability wins, but Taleb says you should focus on the distribution of outcomes. A strategy with 90% wins but minus 10R drawdowns is worse than one with 50% wins and 1R losses. Why? Because tail risk is exponential. The math isn't symmetrical, and most traders don't do the math. He exposes a flaw in human intuition. We're terrible at thinking about low-probability, high-impact events. We underweight their importance until it's too late. And that's why safe systems suddenly implode. They weren't safe, they were fragile, and fragility gets shattered by randomness. So what can you do? First, invert your approach. Stop asking, how much can I make? Start asking, how much can I lose, and can I survive it? Every trade must be survivable. Every position must assume that the improbable will eventually happen. Second, design for antifragility. That means building systems that benefit from volatility. Taleb praises strategies like long volatility, deep value buying, or options hedging. Even if they underperform most days, they explode in rare events, in your favor. That's the opposite of the turkey trade. That's power. Third, develop emotional antifragility. Tendler says you must mentally rehearse worst-case scenarios. Feel the panic, visualize the loss, then build rules to protect against it. Taleb agrees. If you fear the unexpected but haven't prepared for it, you're just gambling with denial. Final test. Ask yourself, what trade could blow up my account tomorrow? If you can't name one, you're blind to risk. If you can, but you're still holding it, you're gambling with your future. Because in the end, trading isn't about being right. It's about being alive when others aren't. And that means you don't just survive randomness. You build for it. You want certainty. You want to know this trade will work. You want a strategy that delivers every time, a setup that never fails, a signal that guarantees profit. But let's rip the Band-Aid off. Certainty doesn't exist in trading. Taleb would tell you, the market is a machine of uncertainty masquerading as precision, and the faster you let go of needing to be sure, the faster you become a real trader. In Fooled by Randomness, Taleb attacks your obsession with prediction. He says we are biologically and culturally conditioned to crave certainty. Our minds want clean lines and defined outcomes. But markets don't play by those rules. They are probabilistic, not deterministic, which means no matter how solid your edge, randomness always has the final say. You felt it. You followed the plan, took the setup, price reversed. You stared at the screen like, that wasn't supposed to happen. But Taleb would say, that mindset is the problem. You thought in terms of certainty when you should have been operating in probability. Every trade is a roll of weighted dice, nothing more. And if you expect more, you'll break. Let's get specific. You often build confidence on recent trades. This setup's been working all week, but that's just recent probability, not universal truth. Or you get a confluence of signals, support, volume spike, candle pattern. You say, it has to bounce. No, it might bounce. And if you internalize that difference, everything changes. You stop marrying outcomes. You start managing risk. This mindset shift is echoed in Douglas's Trading in the Zone. You don't need to know what's going to happen next to make money. Taleb agrees, but adds the brutal caveat. You have to be okay being wrong. Repeatedly, publicly, even after doing everything right. But here's where it gets hard. Your brain hates ambiguity. Taleb explains how evolutionary wiring makes us prefer false certainty over admitted ignorance. That's why traders often invent rules or justify decisions after the fact. We want to believe we knew. But real trading mastery, it lives in probabilistic thinking. It's saying, this is a high probability setup. I'll take it. If it fails, I exit. That's it. Taleb contrasts this with the experts who give precise forecasts with zero accountability. He mocks them, rightly, because precision in probabilistic domains is a joke. It's noise wrapped in a suit. And many traders do the same. They try to look certain, to act confident. But confidence is only meaningful when it's based on process, not prediction. So how do you train probabilistic thinking? Start by reframing every trade as a test, not a certainty. This setup usually works. Let's see if it does this time. That's not weakness, that's strength. Second, stop using the word should in your trade analysis. It should bounce, it should reject, it should follow through. Taleb would say, should is a symptom of denial. Replace it with may. Third, track the distribution of your outcomes. Don't just focus on the winners. Study how often your edge fails and how you respond. Taleb reminds you, a good strategy isn't one that always wins. It's one that survives losses. In probability, the edge is in repetition, not in individual results. Now let's address the pain point. Your emotions won't like this shift. Letting go of certainty feels like letting go of control. And it is. But it's also liberation. When you stop demanding the market prove you right, you stop overtrading, you stop revenge trading, you start flowing with the game, not fighting it. Tendler talks about emotional control as a function of expectation. The more rigid your expectation, the more emotional your reaction. Taleb builds the foundation for that. The more you expect certainty in a random system, the more volatility you inject into your own psychology. And that's the volatility that ruins your edge. So here's your mindset anchor. I don't need to know. I need to manage. That's it. Every setup is a coin weighted in your favor. Flip it, manage the outcome, move on. That's trading. And that's how you stop being a gambler looking for the perfect trade and become a trader thriving in uncertainty. Because your job isn't to be sure. Your job is to be consistent in a world that never is. You think doubt is weakness. That second guessing means you're not confident. That skepticism undermines your edge. But what if I told you that the opposite is true? That doubt is your armor, your filter, your protection against self-deception? Taleb doesn't just argue for skepticism, he demands it. In a world ruled by randomness, the trader who questions everything is the one most likely to survive. In Fooled by Randomness, Taleb paints a brutal picture of certainty. It blinds you, hardens your thinking, locks you into a single narrative. And when that narrative collapses, you collapse with it. The solution? Cultivate what he calls the skeptical empiricist. Someone who trades based on data, probability, and reality, not stories, predictions, or confidence theater. Let's get practical. Every day you face noise dressed up as information, news headlines, influencer trades, chat room alerts. Taleb's warning is this: most of it is garbage. Worse, it's dangerous garbage because it's dressed in credibility. Someone with a following posts a chart and suddenly you question your plan. Someone gives a macro opinion and you hesitate on execution. Skeptical thing gives you the tools to separate signal from noise. But skepticism doesn't mean paralysis. It doesn't mean doubting everything so you never act. That's cowardice. Taleb's version is stronger. It's what Tendler calls informed doubt, the ability to say, this could be true, but let's verify. Or, this trade looks valid, but how does it fit my plan? It's trading with open eyes. Here's where most traders go wrong. They confuse confidence with certainty. Taleb says, true confidence includes the confidence to admit you don't know. That's powerful. Imagine saying, I have an edge, but I know it can fail. I'm prepared for that. That mindset is bulletproof. You've likely met traders who sound so sure of everything. This will break. That was obvious. But if you ask them, how many setups failed like this last year? They go quiet. That's dogma, not data. Taleb dismantles this illusion. Anyone who speaks with complete certainty about the markets is either lying, deluded, or moments away from being humbled. Compare that with Bellafiore's elite traders. They ask questions constantly. They backtest relentlessly. They assume they're missing something. Because they know that a confident trader is not the one who claims to know everything. It's the one who builds systems that can withstand being wrong. Taleb's skeptical mindset also means rejecting experts who talk more than they trade. He exposes the fallacy of the talking head, someone who survives by never risking real capital, but loves giving advice. As a trader, you must train yourself to question authority. Just because someone has credentials doesn't mean they understand risk. Just because someone is rich doesn't mean they understand how they got there. In fact, Taleb says the best sign of intelligence isn't how well someone explains things. It's how clearly they acknowledge uncertainty. You want to model thinkers who say, here's what I'm seeing, but I'm aware I could be wrong. That's real wisdom. Here's a practical drill. Before every trade, ask, what would a skeptical trader question about this setup? Maybe it's confirmation bias. Maybe it's overfitting. Maybe you're just trading because you're bored. Write those doubts down. Then decide with clarity. This doesn't make you weak. It makes you bulletproof. And doubt shouldn't stop after execution. Your trade review should be a place of ruthless questioning. What part of this was luck? What variable did I underestimate? What's the most dangerous assumption I made today? Taleb would say, you're not reviewing to feel better. You're reviewing to get sharper. This attitude aligns perfectly with the psychological principles in Douglas and Tendler. They all point to this. Your growth as a trader doesn't come from confirmation. It comes from confrontation with your own beliefs. The stronger you challenge them, the stronger your edge becomes. Because in a game of infinite uncertainty, your only defense is infinite humility. So don't aim to be right. Aim to be resilient. And that starts with doubt. You've been trying to control randomness, tame it, outsmart it. But Taleb turns the table with one final lesson that redefines your entire mindset. You can't beat randomness, but you can benefit from it. This is the leap from fragility to anti-fragility, where shocks make you stronger, uncertainty becomes your fuel, and volatility works for you instead of against you. In Fooled by Randomness, Taleb lays the groundwork for this transformation. Most people design their systems to survive normal conditions. But the traders who endure and thrive are those who build systems that improve when stress hits. They're not just robust, they're anti-fragile. And that's the mindset shift you must embrace. Let's clarify. A fragile trader is overleveraged, overconfident, and vulnerable to shocks. One unexpected event, and it's game over. A robust trader can absorb randomness, but they don't grow from it. They just endure. But the anti-fragile trader, they get better when randomness hits. Why? Because their system is designed to expose the flaws, reveal the edge, and expand their resilience. You may have already seen glimpses of this. Think of the times you followed your stop loss and felt frustration, but avoided a major drawdown. Or when market volatility exposed a flaw in your system and forced you to revise and upgrade. That's anti-fragility in motion, growth through stress. Taleb is clear. Randomness is not the enemy. Your response to it is. Most traders waste their energy trying to predict, avoid, or deny randomness. But Taleb says the real skill lies in positioning, in building strategies that have limited downside and unlimited upside. That asymmetry is where anti-fragility lives. Let's talk structure. You want trades that cost little to enter, but pay big when they hit. You want systems where losing is survivable, but winning compounds. You want setups that invite volatility because they're built to expand in it. This is the opposite of chasing consistency. It's embracing the unevenness of markets and designing around it. This is where Taleb's ideas echo Bellafiore and even Tendler. Bellafiore teaches traders to play offense when you're strong, to increase risk after you've proven edge and built cushion. That's anti-fragility. Tendler teaches emotional resilience through exposure, feeling stress without breaking. That's psychological anti-fragility. Taleb connects the dots. When randomness tests you, do you collapse or evolve? And here's the kicker. Anti-fragility isn't just a system trait. It's a mindset. It's the belief that you can absorb chaos and improve from it. So instead of panicking during drawdown, you analyze harder. Instead of forcing trades after a loss, you build discipline. Instead of fearing volatility, you study its patterns and position accordingly. Practical step? Audit your entire trading system for fragility. Where are the single points of failure? Where are you exposed to large losses without preparation? Where are you depending on everything going right? Taleb would say, redesign for chaos. Expect disruption. Build buffers. Add redundancies. Create escape hatches. Another exercise, build what Taleb calls a barbell strategy. This means combining extremely safe positions, capital preservation, stop-loss rules, with small exposures to extreme upside, option plays, high R setups, event-driven trades. The middle, where most people live, is too fragile. The edges are where you win. And emotionally, cultivate volatility as a teacher. Taleb says, the fragile fears disorder, the anti-fragile loves it. That means reframing stress as signal, fear as feedback, and discomfort as data. Your job is to train your nervous system to stay calm in chaos and extract wisdom from it. Final insight, stop chasing consistency. Chasing it makes you fragile. Design for adaptability. That's how you last. That's how you grow. That's how you win. Not by predicting the market, but by becoming someone who benefits when others break. Because in this game, you don't control the randomness, but you can choose to rise from it. You've now walked through the brutal yet liberating truths in Fooled by Randomness. You've seen how randomness disguises itself as skill, how survivorship bias clouds your judgment, how seductive stories sabotage your edge. You've been warned against trusting your ego, reacting to noise, and underestimating the devastating power of rare events. And you've been challenged to think in probabilities, embrace skeptical thinking, and ultimately, rewire yourself to benefit from chaos, not be destroyed by it. Here's your mission, trader. Go back to part 1 and reread the reality check on luck versus skill. Start journaling your trades, not just for outcomes, but for process. Analyze what didn't happen in your wins. Rip out every unjustified belief and replace it with statistical humility. Rethink your risk like a barbell, safe core, explosive edge, then act. Apply the principles. Let go of prediction. Trust in probabilistic structure. And remember, your edge is not just your system. Your edge is your ability to survive randomness longer than others can. If this hit home, like the video, share your thoughts in the comments, and subscribe for more trader psychology breakdowns. Your growth doesn't come from more indicators. It comes from sharper thinking and a mind built for the chaos of the markets. Stay skeptical, stay disciplined, and remember, you're not here to predict the market. You're here to outlast it.